corporate governance was not a big part of what a hedge fund was about when they first started. I mean, you had in the beginning, let's go back to the 60s when I first started to form hedge funds. You had a domestic fund, you had a general partner. They were generally trading long short equities. Valuations were readily available because you had the New York Stock Exchange valuations. And these guys were people who were talented investors. They were mostly analysts and traders, but they were not prop traders. These were guys who really were analysts and studied companies at that point in time. And what they wanted to do was to have their own little business. They were entrepreneurs. By definition, entrepreneurs are not people who have a great deal of corporate governance procedures on their minds. And they were small. The hedge fund that I started, I think the first one I did was in 1967. Its capital raise was $7.5 million. There wasn't a single institutional investor. Everybody was friends and family. And the friends and family trusted these people. These guys knew each other. And as the great mayor of Chicago, Mayor Daley said, if you can't trust your friends and family, who can you trust? So that was corporate governance. You knew who you were doing business with. And it stayed that way largely until new strategies came into being and new investor groups came in, and that was the institutional investor. But as long as it was family and friends, and as long as you were dealing basically in long short equities, you did not have a corporate governance structure start to emerge. Corporate governance really matters. And I think that what we tend to conflate is the corporate model and the partnership model, or when we're talking about corporate governance. The partnership model, what you have is really no independent outside directors or anything of that sort, but you still have an enormous amount of corporate governance. A well-run manager who's got a substantial amount of money under management is employing corporate governance strategy in the way in which he sets up or she sets up the operations of their business. And they know that this is incredibly important to their investors, as well as to demonstrate to their regulators. So whether you have a manager today, let's say if he's running only a domestic fund, which is unusual today, whereas before the 90s, before the institutional investors came in, most of the money was in domestic funds, and therefore there were no outside directors. Today it's 80% of the money is institutional and it's offshore. So it's a very different situation. But let's stay with the manager who's only got an onshore fund. Valuation procedures have to be thought through. That's corporate governance. Conflict issues have to be thought through. That's corporate governance. The manner in which compliance is developed has to be thought through. That's corporate governance. You may not have a code of ethics. It's corporate governance. So corporate governance exists if you have just a general partner and no outside directors. If you take that model and you now move it to the offshore corporation, now you've imposed upon the corporate governance that exists at the manager level, corporate governance for the directors, because there's a separate corporate governance model with respect to directors. And I think that's in part some of the tension that exists in terms of how does the manager value the corporate governance model of the corporation. Because what they are looking at is the corporate governance model that they have internally in their own organization. And they're both proud of it. They deal with it on a daily basis, and they work very hard at it. And I think sometimes they feel they've got the field covered and they don't need a lot of additional corporate governance from the directors of the offshore fund. In my view, independent directors definitely add value to a fund board, and I think you need to have independent directors on a fund board. First of all, your investors are going to demand it today. These are institutional investors, and they're investing in an offshore fund. That offshore fund has directors. They're going to insist that directors do something. Should those directors be only internal? The answer is no. Because there are many situations that come up where we get enormous benefit from having independent outside directors on the board. You go back to 2008 when you had lots of questions that had to be asked about how funds were going to operate. Should they impose gates? What about their evaluation procedures? You had a crisis. Having independent directors to whom you could pose the questions that had enormous impact upon investors was incredibly important. And, in many respects, the proof is in the pudding. There weren't lawsuits that came out of the 2008 crisis. And in my judgment, a large part of that was because the independent directors on the offshore fund boards really added value. And they pushed managers as to whether it's necessary to close, how you're going to do the valuation, what should be done to protect the interests of the investors as well as the assets under management. So I think it's incredibly important. It's also important to have an impartial, if you will, arbiter when the conflicts of interest come about. If you want to transfer security from one fund to another, who's going to give you the right valuation? Who's independently going to do it? If you have any kind of interested transaction, you want independent people on the board who can either bless it or say, we're not going to bless it under these circumstances. So yes, I believe it's really important, and no intelligent manager today is going to have a board that's not comprised of some independent directors. Well, I don't think it's the job of directors necessarily to keep up with every regulation that's passed. I think what directors need to do is be sensitive to what's happening in the world and sensitive to the fact that they may need advice in particular situations as to what the law does require. So it would be, I spend all day long trying to keep up with what the regulations are. I don't expect directors to have to do what I do. I think directors need to be sensitive as to what's happening, understand the trends that are going on, and at times needed counsel who will explain to them exactly what is required of them under these particular sets of circumstances. There are times in which directors should have available to them counsel other than counsel to the manager.